ExamPrep.School. Indiana Health Insurance Laws and Regulations exam. There are 4 practice exams in this series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Health regulations. Indiana laws and department rules common to all lines. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Under Indiana law, which of the following is a mandatory eligibility requirement for obtaining a resident insurance producer license? A. Providing proof of U.S. citizenship or lawful presence. B. Being at least 21 years old. C. Completing a 4-year college degree. D. Maintaining continuous errors and omissions insurance coverage. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is A. The Indiana Code requires applicants to demonstrate U.S. citizenship or lawful presence. Age requirement is 18, not 21. No college degree is required. E and O coverage is not mandated prior to initial licensure. Reason B is not correct. Indiana sets the minimum age at 18, not 21, for resident producer applicants. Reason C is not correct. A college degree is not a statutory requirement for an insurance producer license in Indiana. Reason D is not correct. Errors and omissions insurance is not required before initial licensure in Indiana. Question 2. Under Indiana reciprocity provisions, a non-resident insurance producer applicant must at a minimum demonstrate which of the following regarding licensure in the home state? A. Resided in Indiana for a continuous period of 1 year. B. Passed the Indiana state licensing examination. C. Held a resident producer license in good standing. D. Completed a pre-licensing education course approved by Indiana. The correct answer is C. Indiana requires non-resident applicants to maintain a resident license in good standing in their home state under reciprocity rules. Passing Indiana's exam, Indiana residency, or Indiana-approved pre-licensing courses are not prerequisites under reciprocity. Reason A is not correct. Continuous Indiana residency is irrelevant for non-resident reciprocity. Reason B is not correct. Reciprocity waives the requirement to pass Indiana's exam if you're licensed elsewhere. Reason D is not correct. Indiana-approved pre-licensing education is not required under non-resident reciprocity. Question 3. Indiana may issue a temporary insurance producer license for up to 180 days under which of the following circumstances? A. Failure to renew the prior license before expiration. B. Death of the appointed producer. C. Appointment to represent a non-admitted insurer. D. Relocation of the producer's designated responsible individual. The correct answer is B. Indiana law authorizes a temporary license for up to 180 days when a producer dies, becomes disabled, or is called to active military service. License renewal failures, non-admitted appointments, or relocations do not qualify. Reason A is not correct. Failure to renew is administrative and does not trigger a temporary license. Reason C is not correct. Representing non-admitted insurers does not qualify for a temporary license. Reason D is not correct. Changing the responsible producer doesn't create grounds for a temporary license. Question 4. Which of the following is a requirement for an entity to obtain an insurance producer license in Indiana? A. Employment of at least 3 individual licensed producers. B. Submission of the entity's financial audit reports annually. C. Designation of an individual as the entity's responsible licensed producer. D. Appointment by the Indiana Department of Insurance Director. The correct answer is C. Indiana requires each business entity to designate a responsible individual who holds a producer license. Annual audit submissions, minimum staff, or direct appointment by the DOI director are not required. Reason A is not correct. No statutory minimum number of producers is mandated for entity licensing. Reason B is not correct. Financial audits are not part of the entity licensing requirement. Reason D is not correct. Licensing appointments are made by insurers, not the DOI director. Question 5. An Indiana limited lines insurance producer license authorizes a producer to transact which of the following? A. Excess and surplus lines insurance. B. Property and casualty insurance policies. C. Life insurance and annuity products. D. Travel insurance coverage only. The correct answer is D. Limited lines licenses in Indiana are restricted to specific coverages such as travel insurance. Property and casualty, life products, or excess and surplus lines require general or specialized licensing. Reason A is not correct. Excess and surplus lines require separate E and S licensing. Reason B is not correct. General property and casualty requires a standard P and C license. Reason C is not correct. Life and annuities require a life and health license. Question 6. Under Indiana law, which individual must obtain an insurance producer license to engage in business? A. A compensated referral service offering life insurance advisory services. B. A salaried employee performing administrative tasks for an insurer. C. A claims adjuster handling existing property loss assessments. D. A person who receives compensation for soliciting group health enrollments. The correct answer is D. Anyone receiving compensation for soliciting insurance sales, including group health enrollments, must be licensed as a producer. Referral services, adjusters, and internal administrative staff have separate classifications. Reason A is not correct. Referral services have a distinct license type and are not classified as producers. Reason B is not correct. Insurer administrative employees are exempt from producer licensing. Reason C is not correct. Claims adjusters are regulated separately and do not require a producer license. Question 7. Indiana requires how many hours of pre-licensing education for an individual seeking a life insurance producer license? A. 10 hours. B. 30 hours. C. 20 hours. D. 40 hours. The correct answer is C. Indiana mandates 20 hours of pre-licensing education specific to life insurance before sitting for the producer exam. No other hour totals meet statutory requirements. Reason A is not correct. 10 hours is insufficient. The statute specifies 20 hours. Reason B is not correct. 30 hours exceed the amount required by Indiana law. Reason D is not correct. 40 hours are not prescribed for life insurance pre-licensing. Question 8. Which organization administers the insurance producer licensing examination under contract with the Indiana Department of Insurance? A. Pearson v. UE. B. Prometric Inc. C. PSI Services LLC. D. Indiana Board of Testing. The correct answer is A. Pearson v. UE holds the contract to deliver licensing examinations for Indiana insurance producer candidates. PSI, Prometric, and state boards are not testing providers for this function. Reason B is not correct. Prometric is not the contracted testing vendor for Indiana insurance exams. Reason C is not correct. PSI Services LLC does not administer Indiana's producer exams. Reason D is not correct. The Indiana Board of Testing is not an actual exam provider. Question 9. During the license application process in Indiana, a candidate disclosed that 5 years ago she was disciplined by another state's insurance department for submitting inaccurate policy illustrations. Considering Indiana law, which of the following is a valid basis for denying her license application? A. Failure to furnish a required surety bond. B. Disciplinary action by another jurisdiction for misrepresentation. C. Previous misdemeanor conviction unrelated to the insurance business. D. Inability to demonstrate a minimum net worth. The correct answer is B. This option correctly identifies misrepresentation as a statutory ground for denial of a producer license under Indiana law. The other listed issues are not specific disqualifying offenses. Reason A is not correct. Surety bond requirements are handled post-licensure and not automatic grounds for denial of the license application. Reason C is not correct. Indiana law disqualifies felony convictions or those involving dishonesty, not unrelated misdemeanors. Reason D is not correct. Net worth requirements do not apply to producer licensing in Indiana. Financial responsibility concerns relate to specific violations. Question 10. An applicant for a producer license in Indiana receives a written denial letter citing failure to meet financial responsibility standards. Under Indiana regulations, which action must the applicant take first to contest the denial? A. Request an administrative hearing before the department within 30 days of denial. B. File a petition for judicial review in circuit court within 60 days. C. Submit updated financial statements and request reconsideration within 90 days. D. Appeal directly to the Indiana Supreme Court within 45 days. The correct answer is A. Indiana law requires a denied license applicant to request an administrative hearing within 30 days as the initial step in contesting a denial. Judicial review is available only after the administrative process. Reason B is not correct. Judicial review cannot be initiated until after the conclusion of the required administrative hearing. Reason C is not correct. Submitting new documents does not substitute for the required hearing request within the statutory deadline. Reason D is not correct. Appeals to the Supreme Court are only available after completing administrative and lower court review. Question 11. An insurer authorized to transact business in Indiana electronically submits a notice of appointment for a newly licensed producer on June 1st. Under Indiana regulation, on which date does the producer's appointment become effective? A. June 1st, the date the notice was filed. B. June 5th, upon receipt of department confirmation. C. June 16th, 15 days after filing if no rejection is issued. D. The date the producer completes the first sale. The correct answer is A. Indiana regulations specify that appointment is effective on the date the insurer files the notice with the department, regardless of later confirmation or sales activity. Reason B is not correct. Confirmation is a processing step, but not a prerequisite for the effective date of appointment. Reason C is not correct. There is no 15-day waiting period. Appointment is immediate upon filing. Reason D is not correct. Sales activity does not affect the statutory effective date of appointment. Question 12. Under Indiana law, what is the maximum administrative penalty per violation per day that the insurance commissioner may impose on an insurer for violating insurance statutes? A. $1,000. B. $5,000. C. $10,000. D. $15,000. The correct answer is C. The Indiana Insurance Commissioner is authorized by statute to levy administrative penalties of up to $10,000 per violation per day for violations of insurance laws and regulations. Reason A is not correct. That amount is below the statutory maximum penalty per violation per day. Reason B is not correct. That figure is less than the maximum amount permitted under Indiana law. Reason D is not correct. That amount exceeds the Commissioner's statutory penalty authority per day. Question 13. Which best describes the primary function of the National Association of Insurance Commissioners, NAIC, in relation to Indiana insurance regulation? A. Facilitate uniform regulation and model law adoption among states. B. Enforce federal insurance laws within the state. C. Set mandatory premium rates for insurers. D. Administer the State Guarantee Association Fund. The correct answer is A. The NAIC serves as a forum for state insurance regulators to develop model laws and coordinate regulatory practices, promoting regulatory uniformity among states. Reason B is not correct. The NAIC does not have federal enforcement authority over insurance. Reason C is not correct. The NAIC does not set binding premium rates for insurers. Reason D is not correct. The NAIC is not responsible for operating state guarantee funds. Question 14. What minimum capital and surplus must a domestic life insurer maintain to obtain and retain a certificate of authority in Indiana? A. $500,000. B. $1 million. C. $2 million. D. $5 million. The correct answer is C. Indiana law requires a domestic life insurer to maintain at least $2 million in combined capital and surplus as a condition for obtaining and retaining its certificate of authority. Reason A is not correct. That amount is below the statutory minimum for a domestic life insurer. Reason B is not correct. That level does not meet the required capital and surplus threshold. Reason D is not correct. That amount exceeds the minimum requirement for a domestic life insurer. Question 15. Which statement correctly distinguishes non-admitted insurers' surplus lines from admitted insurers under Indiana law? A. Non-admitted insurers are required to file policy forms with the department for approval. B. Non-admitted insurers must submit all rate filings for prior approval. C. Non-admitted insurers are subject to the same financial examinations as admitted insurers. D. Policies issued by non-admitted insurers are not covered by the State Guarantee Association. The correct answer is D. Surplus lines insurers are non-admitted, and their policyholders are not protected by the Indiana Life and Health Insurance Guarantee Association, whereas admitted insurers participate in the guarantee fund. Reason A is not correct. Non-admitted insurers are not required to file policy forms for approval. Reason B is not correct. Non-admitted insurers do not follow the prior approval rate filing requirement. Reason C is not correct. Non-admitted insurers are exempt from the same financial examination schedule. Question 16. An insurance company incorporated under the laws of Ontario and authorized to transact insurance in Indiana is classified by Indiana law as which type of insurer? A. Domestic insurer. B. Foreign insurer. C. Alien insurer. D. Surplus lines insurer. The correct answer is C. Insurers organized under the laws of jurisdictions outside the United States are classified as alien insurers when transacting insurance in Indiana. Reason A is not correct. A domestic insurer is incorporated under Indiana law. Reason B is not correct. A foreign insurer is incorporated in another U.S. state or territory. Reason D is not correct. Surplus lines refers to non-admitted underwriting status, not incorporation origin. Question 17. A market conduct examination by the Indiana Department of Insurance requests an insurer's claim files from the past 36 months. The insurer objects to disclosing files older than 24 months. Under Indiana law, what is the maximum retroactive period examiners may review for compliance purposes? A. 48 months. B. 36 months. C. 24 months. D. 60 months. The correct answer is B. Indiana regulations permit market conduct examiners to review claim files and related records for up to 36 months from the date of examination. Reason A is not correct. Examining 48 months exceeds the statutory 36-month look-back period allowed for market conduct reviews. Reason C is not correct. Limiting review to 24 months understates the maximum period examiners are authorized to access. Reason D is not correct. A 60-month review period is beyond the regulatory limit for market conduct examinations. Question 18. During a financial condition examination, examiners determine an insurer's risk-based capital ratio has fallen below required levels and statutory surplus has eroded. After reviewing the report, which regulatory action is the department most likely to require? A. Immediate revocation of the insurer's certificate of authority. B. Submit a plan to restore capital and surplus within a prescribed time frame. C. Suspension of all claim payments until surplus is replenished. D. Appointment of a third-party manager to take control of operations. The correct answer is B. When an insurer's capital and surplus fall below statutory requirements, the department typically mandates a remedial plan to restore them within a set period, rather than immediately revoke authority or suspend claims. Reason A is not correct. Revocation of authority is a severe sanction reserved for willful or uncorrected violations after remedial measures fail. Reason C is not correct. Suspending claim payments would harm policyholders and is not a statutory remedy for insufficient surplus. Reason D is not correct. Appointing a manager is used in formal rehabilitation or liquidation, not for initial surplus restoration. Question 19. Under Indiana insurance law, which action by a producer constitutes misrepresentation? A. Failing to provide a copy of the policy summary upon request. B. Advertising a policy using an inaccurate interest rate guaranteed by the insurer. C. Suggesting an insurer is more financially stable than it actually is without support. D. Offering premium financing through a third party. The correct answer is B. This option is a false statement about policy terms promising an interest rate that the insurer does not guarantee meeting the statutory definition of misrepresentation under Indiana law. Reason A is not correct. This describes a disclosure violation rather than an explicit false statement about policy terms. Reason C is not correct. That action would fall under defamation or competitive disparagement, not misrepresentation of policy provisions. Reason D is not correct. Offering financing through a third party is permissible and not a misstatement of policy terms. Question 20. Under Indiana Administrative Code provisions for insurance advertising, which practice ensures compliance with required truthfulness standards? A. Including a statement that policy benefits and terms may vary by insurer when comparing policies. B. Using client testimonials without disclosing that past performance is not indicative of future results. C. Incorporating comparative charts without noting the basis for comparison. D. Submitting all advertisement scripts for prior approval by the Indiana Department of Insurance. The correct answer is A. This practice qualifies as truthful comparative advertising by clearly indicating that benefits and terms differ among insurers, meeting Indiana's requirement to prevent misleading claims. Reason B is not correct. Testimonial disclosures for future performance apply to securities, but are not a key truthfulness requirement for Indiana insurance ads. Reason C is not correct. Failing to note the comparison basis is non-compliant rather than ensuring compliance. Reason D is not correct. Prior approval of scripts is not mandated by Indiana insurance advertising regulations. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below, we read them all. Find full practice exam books in the description or at ExamPrep.School.